Hi everyone. This comes up a lot. A lot of people are under the impression that gold mining companies are simply a leveraged play on the price of gold. Now, it's actually not true, but it goes unexamined. So in this video, what I'd like to do is I'd like to basically show, using a couple examples, Barrick Gold and Newmont Gold, and how they haven't actually tracked very closely the price of gold over the past few decades. But first, before I get to those charts, let me discuss some of the key differences between gold mining companies and the price of gold, just so that everybody understands what these differences are and why the mining companies might not actually track the price of gold. So first, gold mining companies' profits tend to suffer when the input costs rise. So what are these input costs? A lot of it's energy, so things like diesel fuel. There's also labor costs. There is the cost of giant earth movers, and also the replacement parts, such as tires for those giant earth movers. And so if those input costs are rising faster than the price of gold is rising, the profitability of the company suffers, and so the share prices might go down, even if the price of gold is going up. Second, miners are actually leveraged via their fixed costs to increases in the price of gold, but they're also leveraged to the increases and decreases in their input costs. So again, it's not just gold price. Third, mining companies tend to hedge the price of gold by selling futures. Now they do that because by the time the gold deposits are identified, proven, all the permits are filed for and granted, and the mine is put into production, a lot of time has passed and a lot of capital cost has been expended by the company, and a lot of borrowing has been done. And so the profitability of the company tends to be very uncertain unless they can lock in a future price. So a lot of companies tend to do this. In fact, Barrick was very famous for this back in the 1980s and 1990s. They sold a lot of gold forward in the futures market. And so the more they tend to lock in the price of gold, the less the profitability of the company will actually track the price of gold. So fourth, there are a lot of differences between different mining companies. So we have junior mining companies that largely make their profits through exploration and sale of properties to the larger senior companies. And then we have royalty companies versus non-royalty companies. Now the royalty companies tend not to be subject to input cost changes like the non-royalty companies do. Miners also produce byproduct metals. So not only do they produce silver, but a lot of gold mining companies also produce copper, lead, and zinc. And so as the amounts that they produce of these commodities and the prices of those commodities change, it tends to have an impact on the profitability of the company and thus have an impact on the share price. So next, we have gold mining companies sometimes pay dividends to shareholders. So sometimes this is a way to compensate the shareholders as they wait for the share price to reflect the fact that these companies are investing in new properties. Next, mining companies deplete their reserves as they produce. So unless they go out and locate new reserves and develop new mines, they're actually going to be depleting their reserves, and so the mining companies can't exist long term without the exploration cost. And so a lot of what makes up the mining company share price is expectations of the profitability of the new reserves that they've acquired or found. Next, mining companies tend to be very subject to management decision quality. So, for example, management may decide to do a practice called high grading. And that is when it becomes very expensive to produce gold, what they might do is they might go after all of the very cheap to produce gold first. And then as the gold deposits deplete, it only leaves left behind the harder to extract gold, which increases their cost long term, and that may have a negative impact on the share price. And finally, gold mining companies are subject to geographic and political risk. So unlike gold, a gold mine is very, very difficult to move. And there are instances in time, in fact there is a recent instance going on right now, where one of the gold mining companies may actually face nationalization of their mines. But there have been other cases, such as in South America. I remember Bolivia back in the 1990s had, in the 2000s, had nationalized some of their natural gas resource companies. So anyway, these are the main differences between what impacts the price of the shares of gold mining companies versus movements in the gold price. So now let me move on and compare Barrick Gold and Newmont mining to the price of gold, and I will also include the price of oil as well, just to show you how sensitive the results of the mining companies would be to energy inputs. So here we have in red, basically what happened to shares of Barrick starting in 1980, going all the way to the year 2021. Shown in blue is Newmont mining. Shown in dark yellow is the price of gold, and shown in black is the price of West Texas Intermediate crude oil. So we can see that, despite the weak period of time from 1980 to 2001 for the price of gold, the price of Barrick shares actually did quite well. And part of this was due to the fact that they strongly hedged future production through the sale of futures, and they were also a very small company starting in 1985, and so they grew much more easily than Newmont mining. So despite the fact that the gold price period was weak for the first decade and a half here of this time period, Barrick actually did quite well. Now Newmont did okay also, and that's because they were deriving their profits largely from the production of gold. And so it wasn't necessarily the price of gold that was impacting them so much as the differential between the input costs and their sale costs. And as we can see, the period from 1985 to 2001 was actually also a period of weakness for energy in addition to a period of weakness for the price of gold. And so Newmont actually did okay until we got to about 1996, at which point the price of Newmont shares basically fell out of bed. Now let's take a look at what happened during the period of secular strength for the gold price, going from 2001 or 2002 up to the present in 2021. We can see that the price of Newmont did do okay, but it did not move nearly as strongly as the price of gold did. And as a consequence, we can see that for this entire 3.5 decade period, despite the fact that Newmont had originally led in terms of total return, it didn't do nearly as well over the past couple decades. And so overall, Newmont only edged out returns in physical gold by a little bit. And so this would call into question whether or not gold mines are actually truly a leveraged bet on the price of gold, because we can see that the price of gold did increase substantially over this 3.5 decade period, even though Newmont really didn't increase much more than that. Barrick also had a period of weakness over the past couple decades. You'll notice that its returns have been almost stagnant over the past couple decades, despite the fact that gold's price has increased 6 or 7 times. And a lot of this has to do with Barrick's hedge book, as I had mentioned, as well as increases in their input costs, which is mainly reflected from the increase in the price of energy, because we can see that oil did hit a secular trough back in 1998, 1999. Okay, so let's move on and let's compare returns over time periods here. So I'm going to advance my slides. And so what this is showing is forward 5-year returns. I look at 5-year returns because from year to year, there's a lot of noise. So let's take a look at 5-year returns starting in 1985 and moving forward. So these bars would show us the relative increase in total returns for Newmont mining, for Barrick mining. I cut the chart off here at 400% just to avoid condensing the scale on these future bars here, because Barrick's returns in 1985 and 1986 were actually greater than 1,000%. We can see the increase over 5 years in the price of gold. It was actually quite weak starting in 1985, very weak in 1986. It was actually negative in 1987 and 1988. But we can see that the relative returns of Newmont and Barrick actually moved in the opposite direction over 5 years moving forward than the price of gold, and so on and so forth. And we can see that for a lot of this period of time, especially during the first decade here in this graph, we can see that the returns of the mining companies actually weren't even in the same direction as the returns of the price of gold. They only started moving in lockstep starting in 1993 and moving on to about 2008. And that's the point in time at which they actually diverged in direction again. And we can see that, starting in 2008 and 2009, the price of gold, moving forward 5 years was actually quite strong, even though the returns from Barrick and the returns from Newmont were quite weak. Now, I did some correlation coefficient estimates here, using this data, and we can see that the correlation coefficient between gold and Newmont mining stock was about 0.29, so it was actually quite weak. We would only consider a correlation coefficient of maybe 0.5 or more to be a significant correlation. The correlation between gold's price and the return on Barrick gold stock was actually slightly negative. So this would say that there really is no meaningful correlation at all between the price of gold and Barrick stock. Now, if we take a look at the correlation between Newmont mining and Barrick gold, there actually is a significant correlation there. Over 5-year time periods, they move together with a correlation coefficient of about 0.6. So that's meaningful. And so that highlights the fact that these companies are in fact impacted by those other factors the same, such as the cost of giant earth movers, the cost of diesel fuel, the cost of labor, etc. If we take a look at the correlation between crude oil and Newmont, Barrick, and regular gold, we can see that there's somewhat of a correlation between oil and Newmont, although we wouldn't say that it's strong enough to be meaningful. There's no correlation between the price of oil and the returns of Barrick stock, and there is a meaningful correlation though between the price of oil and the price of gold. It actually turns out to be about 0.6. So anyway, there it is, folks. These are a couple examples of how gold stocks really truly do not even necessarily follow the price of gold, let alone act as leveraged bets on the price of gold. So I just wanted to bring that to everybody's attention. I hope you enjoyed this video, and if you'd like to see some detailed articles on this type of subject, please check out my Patreon site. Thanks for watching.